Let's kick off this explainer by talking about the Johnson & Johnson paradox, paying for safety. Okay, so Johnson & Johnson has spent 64 consecutive years doing something that is honestly pretty extraordinary. They've increased their dividend every single year. We're talking through recessions, massive inflation spikes, market crashes, global crises, you name it, J&J just kept bumping up that payout. It's an unbelievable record, and it rightfully puts them on almost every serious dividend investor's watch list. But that brings us to a rather large paradox.
64 years. That track record makes J&J a legendary defensive stock. When you're looking for a safe haven for your capital, well, this kind of relentless consistency is exactly what you want to see. But here's the major problem we need to unpack today. Just because a company has a pristine, basically bulletproof history doesn't automatically mean that today's stock price is actually cheap.
So, are investors paying too much for safety? That is the central question we have to answer. As of August 2026, J&J was trading right near the upper end of its recent range, hovering around $270 a share. And at that price point, it's offering only about a 2% dividend yield. So we really have to step back and ask ourselves, is this stock an actual defensive bargain right now? Or are investors literally just paying a massive premium so they can sleep well at night?
To figure this out, it's absolutely crucial that we separate the business from the stock. Because look, make no mistake here, we are not looking at some collapsing healthcare company. Quite the opposite. The operating performance of the business is actually improving significantly. But at the exact same time, the stock price has climbed to highly elevated levels, closing recently near $270.24. So the point is, we aren't sitting here questioning if J&J is a good company. It is, period. The real question is whether it's a good stock to buy at this specific elevated price point.
Let's look at the immediate catalyst that has everybody's eyes on J&J right now. They recently declared their Q3 2026 dividend at $1.34 per share. On an annualized basis, that's a solid $5.36 per share. The ex-dividend date is coming up on August 25, 2026, with the actual cash hitting accounts on September 8th. But hey, I've got to warn you, do not make the classic amateur mistake of buying a stock just to collect the upcoming dividend. The share price naturally adjusts around these ex-dividend dates, so it's not just free money. You always need the underlying business to represent a solid long-term value. And speaking of that underlying business, $25.3 billion. That is J&J's reported sales for just the second quarter of 2026 alone. Think about that scale. This absolutely proves they aren't just limping along as some old-school legacy pharmaceutical dinosaur. No, they are actively thriving and churning out highly meaningful revenue on a massive global scale.
So let's peek under the hood and break down exactly what that growth looks like. We're talking about a 6.6% year-over-year sales increase. Combine that with 5.7% adjusted operational growth and an adjusted earnings per share of $2.90. Those are incredibly impressive quarterly metrics. In fact, they were so undeniably strong that management confidently raised their financial outlook for the rest of 2026 right after these results came out. This totally changes the narrative from a company that's just treading water to one that is actively expanding.
Where exactly is all this growth coming from, though? Well, it boils down to a brilliant, dual-engine approach to the healthcare sector: innovative medicine and MedTech. Innovative medicine gives them broad exposure to major pharmaceutical categories, while MedTech covers advanced medical devices and procedures. This diversification is the secret sauce here. It means J&J's resilience comes from not relying on just one single blockbuster drug or one tiny niche market. That gives them a tremendous edge over a high-risk, pure-play biotech firm.
Now, this right here is probably one of the absolute strongest arguments for owning the stock. A staggering 75% of J&J's total sales come from products that hold a number 1 or number 2 global market share position. Seriously, take a second to process that. 75%. The remaining 25% is literally all their other products combined. When you dominate market share to that degree across a widely diversified portfolio, you create an economic moat so incredibly deep that competitors find it nearly impossible to cross.
Let's shift gears to the MedTech advantage for a second and see how this is building their future. This division doesn't always get the flashy headlines like breakthrough pharma drugs do, but they are literally building the next generation of healthcare by pushing aggressively into robotic and minimally invasive surgery. Why does this matter to you? Because as our global population inevitably ages and medical procedures get more sophisticated, the demand for this advanced medical tech is only going to explode.
But despite all that fantastic growth, we have to pivot right back to our core conflict: 2%.
Let's just be totally blunt here. At a $270 price point, that annualized dividend of $5.36 represents a yield of just about 2%. That is not a huge yield by any stretch of the imagination, especially when you compare it to plenty of other high-yield stocks out there right now offering a lot more income. If your main goal is grabbing outsized current income for your portfolio today, JNJ probably isn't your immediate winner.
But hey, for the income investors watching, don't panic just yet. A dividend is completely useless if the company can't actually afford to pay it, right? Well, independent analysis estimates that J&J has a very safe 60% payout ratio. That means only 60% of their earnings are going toward paying that dividend, which is heavily supported by massive, robust incoming cash flows. The big takeaway here is that their dividend isn't being artificially propped up by aggressive borrowing. It's highly secure and built on a rock-solid foundation.
All right, let's pull this all together and summarize the bull case. Here are the core reasons to be super optimistic. You've got an incredible 64 years of consecutive dividend growth, a whopping $25.3 billion in Q2 sales, a raised 2026 outlook, excellent diversification across pharma and MedTech, and dominant global market leadership. When you buy J&J, you aren't just buying a 2% yield. You're buying supreme quality, unshakable stability, reliable dividend growth, and prime global healthcare exposure. It is a fantastic defensive, long-term compounder.
Now let's take a breath, get a bit more serious, and outline the bear case. First, as we just established, the yield is only about 2%. Second, the stock is trading at a relatively elevated $270. Third, like literally every major pharmaceutical company, they face constant risks from patent expirations, heavy competition, and severe pricing pressures. Fourth, long-running litigation is a persistent, expensive shadow hanging over the company. But finally, and this is the golden rule you really must remember, even a flawless, world-class company is going to give you mediocre returns if you just pay too much for it. The danger of overpaying is the real risk here.
When we break all this down into an objective J&J scorecard, the contrast becomes super obvious. Business quality, an undeniable 9 out of 10. The dividend history is a perfect 10 out of 10. Defensive characteristics and balance are both rock-solid 9s. But scan down to the current valuation, and we're looking at a 6.5 out of 10. That brings the overall score to an 8 out of 10. And there is our paradox, beautifully illustrated. J&J can be an absolutely incredible company without being an incredible bargain every single day of the week. We have to ruthlessly separate the stellar business from the current price tag.
Which brings us to the final verdict. If you are hunting for explosive textile growth, J&J isn't it. If you want a massive current yield, it isn't it either. Our structured verdict? It's a buy on weakness, a hold at elevated prices, and definitely a don't chase a rally. Look, at around $270, we just wouldn't call it an obvious, screaming bargain. We like the company itself significantly more than we like the current entry price, and as an investor, understanding that distinction is absolutely vital. So how should you play this going forward? Honestly, try to ignore the daily price movements. The ultimate metric you really need to keep your eye on is free cash flow. This is the financial lifeblood that supports the dividend, fuels shareholder returns, funds critical research and development, allows for strategic acquisitions, and effectively manages their debt. If J&J keeps growing its operating business while maintaining that strong free cash flow, their long-term defensive dividend thesis is totally intact, no matter what the noisy daily stock chart is doing.
Considering the supreme quality of this business versus its current premium valuation, what is your next move? Would you pay up for safety at $270, hold your current position, or are you waiting for a pullback? In a market that is just desperate for certainty, sometimes the hardest thing to do is wait for the right price. Let us know your strategy in the comments. Thanks so much for joining me on this explainer, and as always, keep learning.